So you can write that as a as a new topic, tax administration. Administration, right? You know, as you can see, this really connotes to capping up everything. We are like finishing and wrapping up everything, right? The taxation system in Zimbabwe is administered by ZIMRA, you know, Zimbabwe Revenue Authority. It's administered by ZIMRA, Zimbabwe Revenue Authority. Taxation system in Zimbabwe is administered by ZIMRA, which is Zimbabwe Revenue Authority. Actually, it is administered by the Commissioner of Taxes, so to speak. But the Commissioner of Taxes heads ZIMRA. No wonder why, if anything goes wrong, if you've got issues with ZIMRA, you sue the Commissioner of Taxes. You don't actually sue ZIMRA, but the Commissioner of Taxes, because it's just an authority. It's not a separate legal entity from the Commissioner. You actually sue the Commissioner of Taxes, but of course, the Commissioner of Taxes then acts on behalf of government. Right? The following are features of a good tax system. Features of a good taxation system. Of a good taxation system. You know, for taxation system to be ideal, it must actually have these features, failure of which you may not achieve the intended results from taxing your citizens. The first one is equity or fairness. Equity or fairness. Guys, equity or fairness. When we say equity or fairness, we are simply saying the taxation system must be perceived and to be fair, and be fair in fact, meaning there's factual fairness and perceptual fairness. It must be fair, meaning everyone should be paying a fair share of tax, and that should be what is obtaining on the ground. So there is what is called horizontal fairness. Horizontal fairness. You know, horizontal fairness, we are saying if we are earning same income, we should pay same tax. That's called horizontal fairness. And there's also what is called vertical fairness. Vertical fairness. By vertical fairness, we are saying if you are earning more, you should also pay the same proportion of tax with the one who is earning less. Let me repeat. If you are earning more, you should pay the same proportionate tax with the one who is earning less. That's vertical fairness. So you do notice, if the tax rate is 20%, it should be 20% to the person who is earning 500 and 20% to the person who is earning 5 million. We call that vertical fairness. But however, in practice, there is a certain amount of tax which is exempt, a certain amount of income which is not even taxed. So you do notice, no wonder why we do have regressive tax. You know, there are regressive taxation. There's also progressive tax, and there's also uniform tax. So what is regressive tax? Regressive tax is it's a situation where if you are earning more, the rate of tax decreases. Suppose you are earning 10,000, the rate of tax is 35. As you earn 2 million, the rate of tax might be 20%. So there are benefits of regressive tax. It encourages people to earn more, meaning it boosts the propensity for people to earn more. but it may be perceived to be unfair by others, to say, look, those who are earning more are being taxed less. So there might be drawbacks for regressive taxation. Now there's progressive tax. Progressive tax, it fosters on redistributing income from the rich to the poor, where the higher the income that you earn, the more the tax bracket. Our payee system is progressive taxation. You know that? Payee, because the tax rate increases as the bands of income increases. So the payee system in Zimbabwe is a progressive tax. And then there is uniform tax. Uniform tax is when same rate of tax is applied throughout. Like corporate tax in Zimbabwe, it's a uniform tax. We just say 24% throughout. So it's a uniform tax. So you do notice these are tentacles of fairness. There are benefits and disadvantages of these particular taxation systems. Then number 2, it must be transparent. Transparent. By transparency, we are saying the revenue generated, we should actually see how that money is being used. If money is, if government is just taxing people and corporates, and we don't necessarily see how that money is being used, you usher people in a defensive or resentment mode. They won't be in a position like they want to pay tax any longer because you are not doing it in good faith. That's transparency. And then there is simplicity. Simplicity. Because it's like government is collecting tax from people and corporates. It should be simple to pay tax. Unlike a situation where I just want to pay $10, I complete 10 forms. I just need to pay $10. I go through 10 forms to be completed, 10 returns. You should not usher your taxpayers into a maze of returns. You put them off. They won't see the need really to pay this tax on the borders of simplicity. It might not be that simple. Now there's an element of adequacy. Adequacy. If we make you the Commissioner of Taxes, we expect you to provide to come up with adequate taxation policies. Adequacy meaning the fiscal goals for the government, the forecast receipts, the forecast expenditures, the votes that have been put across. What is it that the government expects to pay? What is it that the government expects to receive? All that. So as a way of addressing that, make sure you come up with taxation measures which are adequate. So, like in Zimbabwe, you need to ensure that you are taxing almost everyone taxable. Where you can generate tax, are you able to get that tax? Because government is in need of money, and you know all that as a Commissioner of Taxes. So you have to be adequate. How can you tax SMEs? How can you tax small-scale gold miners? How can you tax all these informal businesses? How can you tax these? Come up with ways to tax these and make sure they are adequate. Because the reason is there is no country really which cannot have enough money from taxation, though depending on the development needs and expenditure needs of government, we may end up borrowing, meaning running a budget deficit, where expenditure is more than the revenue we are generating from taxes. But under normal circumstances, governments world over are now sliding towards austerity, living within their means. In so doing, cutting on unnecessary expenditures, and painful as it may, but the idea is to make sure that there's adequacy in the taxation that we are generating, in the revenue that we are generating from taxes. And then another is secrecy. You know, secrecy is one of the attributes of an ideal taxation system. It has to be secret. It's a very, very important attribute. If you want to generate meaningful confidence, if you want to garner as much confidence as possible from the taxpayers, notice they will be telling you a lot of things as the Commissioner of Taxes, the nature of business. They'll be declaring where they are getting their revenues, what are their main expenditure patterns. You being privy to that confidential information, you should keep it secret. The Commissioner is only allowed to divulge information from a taxpayer after getting a court order to do so. You must satisfy a judge that this information needs to be made public. It's not like because you are the Commissioner of Taxes, though you can at any time inspect books of taxpayers, but at no time are you supposed to just make that public unless you have got a public duty to do so, unless it is over or it is in the public interest to do so. But under normal circumstances, every employee of ZIMRA swears an oath of secrecy. You know, it's a dismissible offense at ZIMRA for you to divulge personal information. You know that? We actually dismiss you. Then, and these are the issues. So good taxation system must have these. These are just the main ones. The main ones. Actually, especially on simplicity and adequacy, in Zimbabwe, it's quite relevant. You know, how can government really collect money from taxpayers? You know, there was a transaction tax of 2% because after noticing that the economy was around 90% informalized, businesses were no longer declaring revenue. So government then said, for on every transaction, the commissioner or the treasurer was getting 2% transaction tax. You know, that was an attempt to make sure there's adequate revenue collection mechanisms. Right? So we are going to discuss quite a lot of things under tax administration. Then another one is tax avoidance. Tax avoidance. You know, tax avoidance, it's a legal way of minimizing tax liability. Legal way of minimizing tax liability. A legal way of minimizing tax liability by taking advantage of the provisions of the Tax Act. Taking advantage of provisions of tax acts. Provisions of taxation tax acts. Various acts, be it Capital Gains Tax Act, be it VAT Act, be it Income Tax Act. You know, there are various ways you can minimize your tax liability. And if you are trying to minimize your tax liability, we call it tax avoidance. Some call it tax planning. So in companies, we encourage you to do what is called tax audits or taxation health checks. Are you really, you know, benefiting from what the tax provisions say? Most companies are not even benefiting. They just think claiming capital allowances is the only tax avoidance mechanism in place. Here are the various tax avoidance mechanisms. You know, yeah, you may claim. One is claiming maximum capital allowances where appropriate. Claiming maximum capital allowances where appropriate. It's a tax avoidance. Notice that tax avoidance is legal. It's legal. zviri pamutemo kuavoida tax. Kune kunonzi kuavoida nekuevada. Saka another thing is election to transfer assets at ITV for companies, for companies within the same control, companies within the same control, thereby avoiding recoupment. If you transfer at ITV, it means you are if you are transferring assets to companies within the same control, you can choose or elect to transfer them at ITV. If you so choose, no recoupment arises. There is no recoupment that then arises. Another is election to transfer assets at cost between spouses. Election to transfer immovable property at cost between spouses or companies under the same control, so that no capital gains arises. You can actually elect to transfer that. All these are tax planning or avoidance issues. Another is special deductions to farmers. A farmer, there's special deductions like cost of clearing and stamping of land, area-wide geographical surveys, wells, sinking of bores, and construction of dams, water conservation works, or even contribution towards such. We discussed that. Another is drought sales reliefs. Or restocking allowance to farmers. I wonder why I'm saying we are keeping things up. We are not like discussing something new. You just have to know this. If you are asked, how can tax be minimized? Taking advantage of elderly tax provisions. Elderly, there's elderly exempt provisions. Quite a lot. A bit on PPR, sale of vehicle benefit, sale of vehicle benefits, gains on, disposals of marketable securities, old age pension, annuities, old age pension / annuities. All these are exempt. You need to understand that you can as well advise an elder to plan on tax on that. Now, as you have noticed, I have mentioned here marketable securities. If an elder disposes marketable securities, you come to the tax tables like this. Your tax tables will be in Zim dollars. So if you come to capital gains tax, you'll be told here, I mean, if you come to the section of exemptions for elderly taxpayers, which is here, you'll be given these figures. You'll be given these figures in Zim dollars, so don't claim these figures, but just to know where you get them here. Exemptions for elderly taxpayers. All these are exemptions. And also amongst the exemptions, if an elderly taxpayer sells a marketable security, there's a portion which is exempt, not the whole amount, but a portion. You'll be given this figure in Zim dollars, so don't worry. It's a matter of knowing. If you are told that Chipo, who is 62 years, sold shares, know for sure that up of the capital gain that you calculate, remember to take out the exempt portion. You'll be given the figure in Zim dollars here by the examiner. That's what I'm saying. I'm not saying the whole thing is exempt, no. ETC, you know, you can't finish really tax planning issues that are available to companies. I just wanted you to know. And then tax evasion. Tax evasion. So there is tax avoidance and tax evasion. This is an illegal way. Illegal. It's actually illegal or criminal way of concealing the tax liability or failing to pay tax when the liability arises. An illegal or criminal. When we say criminal, in other words, you get arrested for this. You get actually jailed for this. You need to be very careful. No wonder why whatever forms we submit to ZIMRA, normally we sign. No wonder why when it comes to tax matters, we need a public officer, a person who we believe is a person of integrity, who knows the consequences of declaring false information on a ZIMRA return. And if you declare false information, your neck will be online. E.g., you know, concealing sales. You should not be concealing sales or overstating deductions. Another mechanism might be you are concealing sales, overstating deductions, or understating input tax. Understating input tax. Understating output tax. And overstating input tax. This is now for VAT. You know. Another is treating revenues as loans. Revenue as loans. Another is not observing cutoff dates. Cutoff dates or due dates. You know, sale on the 29th of May, you put it in June because you don't want to pay VAT. There are various ways. You know, overall, tax evasion, it's all about declaring false information. declaring false information. So you would notice that's tax evasion. And at instances there are remedies for tax evasion. Remedies for tax evasion. Remedies for tax evasion, meaning what does the commissioner do, the commissioner orders specific performance, obtain an order for specific performance, meaning the commissioner will force you to do things, right? Criminally charge the perpetrator, criminally charge the public officers, charge public officers. Whoever was declared a public officer will be criminally charged. Not necessarily the CEO. If I'm CEO of Heartlands and I tell you to say, can you claim capital allowances for an asset which is not there, or for an asset which has since claimed all its allowances, and you continue doing that, we can be jointly charged, but you are the point man to be charged, point person to be charged. Another is penalties of up to 100%. Then there is of 10% per annum on the amount outstanding. In case of VAT, I told you that you also forfeit. Suppose you take long to register for VAT, you also forfeit your input tax claim. In other words, if you were to claim input tax, but you were eligible to do that, but you register for VAT late, the commissioner will backdate output tax from the eligibility date. Not backdate output tax kubva pawaifana kunge wakaibhadhara, but iwe unozoluza input tax haubvumidzwe kuiclaima. Saka unenge wane ese mapenalties ese waya unocalculate output tax wobva wanzi penalty wobva wanzi chii, quite a lot of things. There is estimated assessment. Assessments. Writing that. These are called concepts in tax administration. They're just some. You need just to know how the commissioner really administers this element of tax here. Estimated assessments. The commissioner may issue an estimated tax assessment. The commissioner may issue an estimated tax assessment. The commissioner may issue an estimated tax assessment if the taxpayer fails to provide one. If the taxpayer fails to provide one. If the taxpayer fails to provide one, or is about to evade, or is thought to be about to evade tax, or is thought to be about to evade tax. If you are thought to be at a risk of evading tax, the commissioner can just estimate the tax assessment and charge you. You can be charged to say, the commissioner can call you and tell you that your tax for this period is so much. Administratively, right? This administratively, comma, estimated assessments are also known as presumptive taxes. Presumptive taxes. You know, from an administration perspective, when the commissioner is calculating tax without records, we say the commissioner is presuming. So we call these at times presumptive taxes. They are levied on businesses such as hair salons, boutiques, in certain instances, such as hair salons, boutiques, transport operators, canteens. You'd notice this issue of presumptive taxes can go a long way in making the taxation system effective. How can you get money from these guys if you allow them to bring you books? If you allow them to give you books, can a combi operator, for example, taxi operator, actually by transport operators, I mean passenger transport operators, not other transport operators. If it's haulage, no, those are proper businesses like Swift and DHL but ideally, you can't tell a barberman to prepare books, a hairdresser to prepare books. Otherwise, as the commissioner, you will never have tax. You will never receive anything from these guys. So in mitigation, what do? You come up with this element of presumptive taxes. You know, presumptive taxes. These are like, okay, you know, presumptive taxes. These are actually estimated taxes. You get that? Then also, are supposed to estimate their tax liability at the start of each year, and pay on a quarterly basis as follows. On a quarterly basis as follows. You know, concerning these issues of estimating, each business must pay QPDs. So you say quarter. You remember this, guys. Quarter, due date. You should estimate, then tax paid. So it's like, suppose you are talking of first quarter, due date is 25 March. 25 March, tax paid is 10% of estimated tax. Right? And then the second quarter is 25 June. And then tax paid is 25% of estimated tax. And then third quarter, 25 September. You know these guys. I don't know that. 30% of estimated tax. Then fourth quarter. You can see it's like we are now summarizing the syllabus. 20 December, and it's 35%, 5% of estimated take. So are you not seeing now? This is what every business is expected to do. Every business must have an estimated tax. You must estimate your assessment to say, this is what I'm expecting. This is what I'm expecting. And so what do you then do? Remember what we said. We say at the end of the year, the final assessment is then prepared. At year end, let's say the final assessment for the year, the final assessment or tax liability is calculated for the year, net of QPDs paid, and must be remitted ZIMRA by the 30th of April. So you would notice 30th of April of the following year. So you would notice if we estimate tax this year, if we estimate tax this year, we then have to pay. You know, QPDs are based on estimated taxes. So what we then have to do is, if we are paying QPDs this year, come here and we now have actual results. We then prepare what is called final assessment. You fill these forms, you know, the 12 Bs for QPDs, and then the ITF 12 Cs for the final assessment. And because you now have actual figures, you do it next year. You make sure that the final assessment for this year is remitted by the 30th of April 2022. All right. You know, there is also what is called self-assessment. Self-assessment nowadays, most businesses are run by sole traders. Sole traders normally they just their self-assessment forms for sole traders, which are not necessarily, you just fill in the form estimating your revenue, and also make sure you provide the commissioner with the final assessment come year end. So the issue is now on how is it being administered. You know, one of the features of a taxation system is simplicity, meaning administrative easiness, or the intended object and the subject, meaning the ZIMRA and the taxpayer, are they able to enter into a relationship, tax relationship, with ease, and discharge their obligations with ease. So this is why we also have this, to allow you as a taxpayer to estimate your own tax, which is called self-assessment. So what is the difference between estimated assessment and self-assessment? Normally, estimated assessment is the commissioner who is saying, this is what you must pay, especially the presumptive taxes. If you are a passenger transport operator, a canteen, a salon, a boutique, what? They just say, this is what you must pay. But if you are the one doing it, to estimate your own tax, those are now self-assessments. Now, you know, commissioner may issue what is called additional assessment. It's like you have estimated your own tax, but the commissioner feels you have not done it well. The commissioner may issue additional assessment. If the tax you had calculated was 60,000, and the commissioner feels 60,000 is an understatement, can issue an additional assessment and say just pay additional 30. Perhaps from your past payment records or from your business volumes, the commissioner feels that more audit is required, but for now, pay additional tax. So in that case, it will be additional assessment. Rarely does the commissioner issue what is called a reduced assessment. It is possible, but it's very rare. Where the commissioner would say, oh, you have overpaid, so you have over-declared, you have overestimated your tax liability, let us issue a reduced assessment. It's rare. So chances are then you then have to make appeals to High Court or Supreme Court, you know. Tax matters, what you do is you appeal. Let us just say appeals. You know, if you are aggrieved or you have reservations, where reservations exist on decisions made by the commissioner, where reservation meaning disputes or disagreements exist on decisions made by the commissioner. You know, by ZWE, we made decisions made by the commissioner. By commissioner, we are just saying ZWE. The taxpayer may launch an appeal. The taxpayer may appeal. The taxpayer may appeal. You know, you may actually appeal. You may appeal to, as a first port of call, if you are not happy with what ZWE has done, you appeal to ZWE. Suppose you are dealing with those guys from ZWE and you are at the board and you feel aggrieved. What you do is you write your letter to ZWE, of course. That's the first thing. So here are the appeal. So the appeal must be in writing. The appeal must be in writing. Writing, clearly stating the grounds of appeal. Clearly stating the grounds of appeal. Please make sure every point that I'm saying here, you are getting it right, because this is your multiple choice. This is your multiple choice. Clearly stating the grounds of appeal. If you feel like you're not happy with what the commission has done, you lodge an appeal. You don't appeal over the phone. It must be in writing. So writing nowadays is email. Actually, I encourage all correspondence with ZWE to be on email. You know, with issues to do with tax, when things they backfire later, you can't be saying I called you. No, you should provide email correspondences. Another issue is the appeal must be lodged within 30 days of the decision. The appeal must be lodged days of the decision. The appeal must be lodged within 30 days of the decision. Another is the appeals process does not preclude the appeals does not preclude the taxpayer to pay the tax due. Doesn't preclude the taxpayer pay the taxes due. So important. This point is important. If you appeal, don't say, suppose you are ZWE is saying pay 45,000, and you then say this much I'm not happy with how you have calculated it, and I'm going to appeal. Whilst you are appealing, it does not mean you must not pay the 45,000. The taxpayer's obligation to pay remains even when the appeal is pending. Taxpayer's obligation, that's what I'm saying, the taxpayer's obligation to pay, obligation to pay tax remains even when the results of the appeal are yet to be received. When the results of the appeal are yet to be received. When the results of the appeal are yet to be received. So important, you still need to pay your tax even if you have lodged an appeal. And you know where you can appeal. It's not like you know, right? If the appeal is dismissed, if the appeal by the commissioner, comma, the taxpayer may appeal to High Court or Supreme Court. You know, you first start with High Court and then Supreme Court, as need be. When I say as need be, meaning if you are saying the dismissal by the commissioner of your case, you are still aggrieved by that dismissal, you can appeal to the High Court or Supreme Court on these particular matters. You can still take them up and make sure you get the satisfactory answer. But if you appeal, it doesn't mean by appealing the results of your appeal are always favorable. No. You know, you can appeal, but still the result is upheld, meaning the decision made by the commissioner, you can still appeal to the High Court and the decision is upheld. It's equally possible that way. All right. Change of businesses. Change of businesses, right? This change of business. Change of business. Now, change of business covers quite a lot of things. These are subheadings I'm just coming up with myself because I know they will help you. So the first one is, it covers like admission or withdrawal of a partner. Let's say there's admission or withdrawal of a partner. You know, there's admission. You are running a business. There's admission of a new partner, or there's withdrawal of a partner. So whenever that is the case, it means a new taxpayer comes. If we were a partnership whilst we were 3, and then we admit another partner, it means we are now a new partnership altogether. We are now a new partnership altogether. So what it means is a new partnership is formed. A new partnership business is formed. Business is formed. So how do we go about it? It means when we are now calculating, like suppose we are now calculating the tax returns, we want to find how much each partner must pay for the period under review. It's easy. It's easy if there was an admission of a new partner. What you simply do now is, in determining, let's say, in determining the tax due by each partner, in determining tax due from each partner, comma, the assessment is time apportioned. The assessment is time apportioned. What do I mean by this? What do I mean by this? i.e., so here is how you go about it. Calculate, you calculate admission, before admission, and tax after admission, by time apportioning revenue and expense items, by time apportioning incomes and deduction items, Actually, you'll be told by the examiner that 60% of revenue was, the examiner can actually tell you that to say 60% of revenue was admitted and 40% was after. So you prepare two schedules. One before admission. So if the admission was in September, it will be for 9 months. And the other schedule after admission, which will be for 3 months. So you calculate tax in the pre-admission period and tax in the post-admission period. So you would notice that profit and loss sharing ratios will also change during these two periods, P&L sharing ratios will also change. You get that? P and loss sharing ratios also change. So this is business change number one. Another business change, we just want to illustrate two. So the second one is conversion of a sole trader to a company. Conversion of a sole trader to a partnership. Trader to a partnership or a company. Now, if you convert a sole trader to a partnership or to a company, or even a partnership to a company, again, a new taxpayer is formed. A new taxpayer, meaning these are now totally new, different businesses. If you were running your business as Mr. Mpatsi and then you feel like, let us have it as CH Limited, the fact that we now decide to have it as CH Limited, it would mean that a new business has been formed. So from ZWE perspective, we now have two taxpayers. So the issue is a new taxpayer is formed. A new taxpayer comes into being. All right. So what does that mean when we say a new taxpayer comes into being? The implications are. By implications, we are saying tax implications. Please pay attention to this. The tax implications are like this. The first one is assets transferred to the company are deemed to have been sold. Assets transferred to the company are deemed to have been sold at their market price at the date of transfer. At their market price at the date of transfer. Assets transferred to the company are deemed to have been sold at their market price at the date of transfer. This one is so important. You know the reason? Because these are now new taxpayers. So if I was running a business as Mr. Mpatse, now I form a sole trader, the assets that I transfer I then form a company. The assets that I transfer to the company are actually deemed to have been sold by me to that company. So there's need to calculate the recoupment and capital gains tax where appropriate. There is need to compute. There's therefore need to compute recoupment and capital gains tax as appropriate on the date of transfer. As appropriate on the date of transfer. On the date of transfer. It's so important. It's so important. Another is the tax returns are also time apportioned. The tax returns or assessments. You know, by returns we mean assessments. When you are calculating the tax due, are time apportioned. Are time apportioned. Apportioned. You know what do we mean by time apportioned? I.e., calculate sole traders tax up to the date of transfer. Calculate sole traders tax up to the date of conversion, and the company's tax from the date of conversion. The company's tax from the date of conversion. In sense, sole traders tax, you calculate it up to the date of conversion because it was a sole trader. So if conversion takes place on 30 April, you calculate sole trader for 4 months. And then for 8 months, it's now a company. Now notice, the market value of assets transferred. This one is another very important. Market value of assets transferred. Is deemed to be the cost. Is deemed to be cost of assets to the company, not to the sole trader, for capital allowance purposes. Now notice, suppose my laptop, I'm using my laptop as a sole trader, and now I want to form a company. I'm using my laptop as a sole trader. What I want now to do is to form a company. You know what I do? This same laptop here, which I'm using as a sole trader, the market value of it is the cost of the laptop to the company, not the amount that I bought it for. Because there's no cash movement, it's a merely transfer of assets. But there's also tax implication, meaning there's need to calculate the sole trader because it's effectively selling assets to the company. So the sole trader must calculate recoupment, capital gains tax if there's specified assets as well. And the new company now must claim capital allowances, not based on the original cost of the assets to the sole trader, no, but based on the market price of the assets on the date of conversion from a sole trader to the company. This one is so important. All these points are important. Another point is still there is assessed losses from the sole trader cannot be allowed as deduction. Assessed losses from the sole trader cannot transferred to the company and allowed as a deduction cannot be transferred to the company allowed as deduction. You know, if is an assessed loss, let's say you know, you formed a company, right? But whilst you were a sole trader, you were making tax losses or assessed losses. Until you know how we treat assessed losses. Ticket assessed loss nas reduce some taxable income in future, because assessed loss inoitwa carry forward as a deduction. You still remember what takati inoitwa carry forward for a maximum of 6 years, unless company ichiita remining. Painenge after remining, it is carried forward indefinitely. But here is the deal. Kana wanga uine ma-assessed loss ako sole trader wofoma company transfer kuti azoreduce ma-profits e-company. Saka ndakuudza kuti unoita sei, unoprepare tax, unocalculate tax ya-sole trader up to the date of conversion. Kana papa ine ma-assessed loss, unobva wadeducta ku-sole traders side. Kana akaramba ari ngori loss, zvavharana. Hauchakwanisi kuti since yaramba ingori loss, ndakuita carry forward kucompany. Nyatsopanzwisisa. Now, tax clearance certificates. Tax clearance nowadays they are available in electronic forms. ITF 263s. It's a form that confirms that the taxpayer, it's a confirmation from ZIMRA. You know, this one is a confirmation, valid, a confirmation valid for a given period of time, valid for a given period of time, from ZIMRA that the taxpayers, that tax matters for the entity are in order, that tax matters for the entity are in order. You know, that's the purpose of tax clearance certificates. You get that as a confirmation from ZIMRA that you are a good corporate citizen on tax matters. That's the purpose. You know, how do you get it? Suppose you want to ask to get the tax clearance certificate. You don't just walk. You know, what you need to do to obtain the clearance. The taxpayer must furnish ZIMRA with, you know, you must furnish ZIMRA with evidence of paying requisite taxes on due dates, and timely submission returns. So under normal circumstances, you must have what is called a ZIMRA file. If you are working for a company and you are in the accounts department, you would agree with me that there is a ZIMRA file where you record things to do with ZIMRA and make sure that that file is in order. That file is in order, because when ZIMRA wants to give you tax clearance certificate, nowadays you are submitting forms electronically, but still those forms, the same forms you are submitting, make sure you are printing and filing. You are printing copies and filing. You are printing copies and filing. When you submit a copy to ZIMRA, make sure you print a copy and file it in ZIMRA file, especially with its confirmation. Remember, on the e-filing platform, as soon as you lodge a payment proof, or as soon as you lodge a filing of a return, there's a confirmation you get that the return has been successfully filed. Print that, staple it to your return that you have submitted, and then filed in a properly labeled and well-kept ZIMRA file. You know, ZIMRA file. If it's being done by a clerk, make sure the clerks are doing it right. They should be doing it right. Otherwise, because when you may be called at short notice to visit ZIMRA offices, and they would ask you to bring the ZIMRA file, or just to do reconciliations with you, and whenever they realize that your file is not in order, you bring enormous doubts to the figures that you're filing, and ZIMRA may then begin to take a keen interest on the accuracy of your filings. And remember, when there was an element of concealing of things and fraudulent misrepresentation of incomes and expenses and stuff, it will then amount to tax evasion. So what then is, having a tax clearance certificate allows business to easily win tenders or contracts. A tax clearance certificate, having an ITF 263, actually, that's the income, it's income tax form 263. It's a matter of forms. ITF 263 allows the business to win tenders or contracts. Allows the business tenders, contracts, and avoid withholding taxes being charged on their invoices. Withholding taxes being charged on their invoices. I said today's discussion is brief. I'm about to finish, don't worry. You know what does that mean? It means if you are my accounts person, suppose you are my creditors clerk, and I say you are in charge of making sure you are paying suppliers, you are validating the adequacy of suppliers' invoices, whether they've indeed supplied whatever they want us to pay. Another obligation that we have is to check ITF 263, So in other words, before paying a supplier's invoice, the taxpayer must, before you pay any invoice, as a taxpayer, you must, there's quite a lot of things that you do. Obtain a tax clearance certificate from the supplier. Actually, request and obtain. A tax clearance certificate from the supplier. ITF 263. Tax clearance certificate from the supplier. You need to get a copy before you pay an invoice. Now, if the supplier fails to give you one, that's B. Supplier if the supplier fails to remit to furnish the ITF 263, I want to pay OK Zimbabwe Limited. I then ask, I have your invoice for $200,000. Do you guys have tax clearance certificate? I ask like that. I request. I need a copy. Nowadays it's easy. They are in digital format. We want if we make you our creditors clerk, unofana ku open a file. Rema tax clearance certificate ima suppliers. Ma tax clearance certificate are valid. Zimengua for 3 months, zimengua for 6 months. Kashoma kwana valid for a year. Saka zvauneta uno open a supplier file. Raunenge wakaisa ma tax clearance certificate are fully filed. Kana 3 months dzangokwana asiri valid uchibvisa uchirasa. Unotobva watorasa kana risiri valid hatichatoride. We don't even need it nearby. Kana kusari bharura wo open another file just in case Zimra yazokuvhizitira. Saka the recommended approach is don't tear them, keep them, and normally tax records let us keep them for a period of 6 years tozobharura hedu kuitira kuti Zimra ikazouya toida kuona. Saka zvaunoita uine file remasuppliers, unovhura file remasuppliers woona kuti okay ane tax clear, kana asina ofona anobva kuemailira woprinta with some file. Always print. Zimra issues let them be filed, even though we are in a period of technology, but they need to be filed unless you have a folder with necessary backup where you'll be saving these on a digital form. So if the supplier fails to furnish you with the tax clearance certificate, what you then do is deduct 10% from the supplier's invoice. Deduct 10% from the supplier's invoice. Deduct 10% from the supplier's invoice and remit it by the 10th of the following month. Remit it by the 10th of the following month. Remit it by the 10th of the following month. You know, that one is a very good point. You remit, aungo deduct 10% wochengeta. Kune vanhu vazhinji vanongo deducta wochengeta. Alternatively, comma, the 10% tax withheld on supplier's invoice, the 10% tax withheld on supplier's invoice, the 10% tax withheld on supplier's invoice is added to output tax, and remitted as VAT. Output tax and remitted with VAT. You know what? Why is this an alternative treatment? It's because aubvumidzwe kungoti rega ndideducte 10% from invoice yasupplier wobva waibhadhara kuzimura by the 10th of the following month. Remember kuti unoibhadhara ikoko unofana kunge wakaregister for withholding tax. Saka tomboti wanga usina kuregister wanga usina ausi registered for withholding tax, aukwanise kunoibhadhara nekuti hauna withholding tax number. Saka zvaunenge wakuita manje unogona kunge wakaregister for VAT, which is common. Saka mari handiti wakabatira masupplier mari uchiti ivo havana tax clearance certificate, saka iwe unoda kuita zvinhu nemazvo. Kana wabata mari dzavo chiregedza kugara nadzozve uchidzibhadhara manje iwewe. unogona kungodziedha kuoutput tax kuya paunokalculata VAT wobva wati withholding tax on contracts, meaning on suppliers invoices, paanenge achinzi withholding tax on contracts. So what are the benefits now of having withholding tax? Zvinoita kuti wane macontracts uye zvinominimiza unopiwa what are the benefits of having tax clearance certificate? Zvinoita kuti uwane mari yako in full. Andozvona, mari yako unoiwana in full, hauna risk yekuti mainvoices anobatwa. Alright, then tax years. Tax years. You know, tax years, these are taxes which a business can register for with ZIMRA. Taxes which a business, or simply a taxpayer, a business can register for with ZIMRA. Register for with ZIMRA and can register for with ZIMRA. There are various tax years. The first one is income tax. Businesses should register for income tax. Income tax. This is done upon formation of business. Normally, the period we use is two weeks. 2 weeks. Normally 2 weeks from the formation. Maximum is 2 weeks. Formation of business. You understand this? You must register for income tax. If you register for income tax, this then allows you to pay QPDs. This allows for QPDs to be paid, for quarterly payment dates to be paid, and annual assessment. And the final assessment and final assessment. That's about income tax. You register for this tax year as soon as you clock 2 weeks. Then there is payee. You need to register for payee. Pay as you earn. It's another tax year. You know, things to do with tax. When we say register for tax, you don't just say I want to register for tax. The identity of a business in ZIMRA records is called business partner number. Any business which is in ZIMRA records has got what is called business partner number. But when you now want to pay tax, though a business partner number is needed, we also need the specific type of tax that we are paying. This is called tax year. It's actually specific types of tax that we are registering. Specific types of tax. These are what we are referring here as tax years. So when are you supposed to register for payee? You register for payee within you register for payee within 2 weeks of becoming an employer. Not of forming a business. But you do notice, under normal circumstances, the first day you trade, already you've got employees. So when we are saying 2 weeks of becoming an employer, you do notice it is similar to just saying 2 weeks of forming a business, because normally you form a business being an employer already when you commence it. Then there's VAT. VAT, you remember, compulsory registration threshold, compulsory registration revenue threshold, compulsory registration revenue threshold, million annum, 1 million. You know, it's 1 million per annum or per month. Once you have your revenue hovering around that, 1, 2, 3, 1, 2, 3, divided by 12, we got it as 83,000. 83, 1, 2, 3 per month. When you have got your revenues hovering around that, make sure you register for VAT. But remember, we told you that certain businesses are exempt for VAT, like educational services. You know, like what we are doing here. These are educational services. And medical services, financial services, domestic water. Those are exempt. So it's not like every business, no. We take cognizance of what we have taught you when you are doing this. And then NASA. That's another. NASA registration. So for NASA within 30 days of becoming an employer. 30 days of becoming an employer. Becoming an employer. You know? 30 days of becoming an employer. Actually, concerning NASA, it's like employees and employer contribute. Employee and employer contributes same amount monthly to NASA. Same amount monthly to NASA. Employees and employers contribute same amount monthly to NASA. Another thing is employees above 65 years do not contribute to NASA. Employees above 65 years do not contribute to NASA. When you are an employee who is above 65 years, you don't contribute money to NASA. Are we together? This time we use 65, not 55. So if you check your payslip, if your payslip deducts $250 for NASA, employer has also paid $250 paid for NASA. So the total amount there that is going to be remitted is 500 NASA contribution. It will be 500. But on your payslip, so if you are asked to calculate total amount to be contributed to NASA, you don't just say it's your employee contribution. No, it's employee plus employer, or just calculate your contribution and multiply it by 2. You can just calculate employees' contributions, get the total, multiply that total by 2. You get the total amount which is remitted to NASA. Another thing is NASA deductions for the month. NASA deductions for a month, for each month must be paid NASA by the 10th, not to ZIMRA, NASA by the 10th of the following month. You know, pay NASA contributions to NASA, no. We pay NASA contributions to ZIMRA. I mean, we don't pay NASA contributions to ZIMRA. No, we pay NASA contributions to NASA. And when? For this past month, April, the NASA contributions were supposed to have been paid yesterday. That was the due date. And then failure to meet the due date, due date, comma, NASA will, this is what NASA will do. If you don't meet the due date, NASA will charge a penalty. Penalty from NASA is called a surcharge or surplus charge. It will charge a penalty of it will charge a penalty of 10% per month on the amount outstanding up to a maximum surcharge of 50% of the amount outstanding. 50% of the amount outstanding. So that's what NASA will do. If you don't pay NASA on time, yes, the deal. It will charge you 10% per month. It's not 10% per annum. So you don't multiply by 360. No. By anything over. So if you owe NASA 2,000 this month, you pay extra 10% of 2,000, which is 200. But this penalty should not accumulate beyond 50% of what you owe. That's what NASA does. And what is the rate for NASA nowadays? Talk to yourself. What is the NASA rate? What is the NASA contributions? Can you type on the feature? Right. So notice, this is how you just calculate NASA. This is from 2020. So I want to make it clear to you. From 2020, the contribution to NASA is now 4.5%. It's now 4.5% up to a maximum monthly salary of 5,000. So if you earn a monthly salary of above 5,000, we don't calculate NASA on that above. We calculate NASA on the 5. Remember, 5,000 is also the exempt bonus. Right. So let me again come to the notes. Are you not seeing when you are facing challenges with ZIMRA? Can you imagine? I just said NASA contributions 2020 Zimbabwe. Of course, I normally search for Zimbabwe. No wonder why it gave me Zimbabwe. This is how it was 3.5%, but it's now 4.5%. So you can come now to this and say NB for 2020. For 2020, comma, NASA contributions are 4.5% percent per employee up monthly salary, the maximum monthly salary, a maximum monthly salary of 5,000. This I have to tell you so that though you'll be given this by the examiner, so don't claim it. Let me show you where you get this. Up to a maximum monthly salary of 5,000. So I'm just highlighting it so that you know. 4.5%. Now, just for me to understand whether you've understood the NASA thing, because NASA, you can lose cheap marks when you get into the exam. Let's say this is Atlan's resources. We have got employee one. These are our employees. Employee one, let me drag. We do have 5 employees, 6 employees. Then age. Age is this one is 48, 5, 7, 66, 67, 50, 42 for employees. And then annual salary, annual salary is, these are actual exam questions. I know you've come across this. Annual salary, this one ends 88,000. Just figurative. Don't worry. Don't say get someone ends at your salary. It's okay. This one ends 120. This one ends. This one ends 48,000. This one ends 65,000. This one ends. This one ends. Okay, so this one ends for let's say 42,000. This one ends 140,000. Now, my question is, these are annual salaries. So my question is, calculate the total NASA contributions for the month of May. Total NASA contribution for the month of May. NASA contribution. Total amount paid to NASA for the month of May. Amount paid to NASA for the month of May. The month of May. Can you work it out for me, or let me do it actually? Let me do it for you. Now, what you need to know is, when it comes to NASA, you simply say solution. These are annual salaries. So what you need then to have is monthly salary. So you simply say for those with annual salary above 60,000, we calculate NASA on 60,000. We calculate NASA on 60,000. Are you getting it? Because it's above 60,000. Remember, monthly maximum is 5,000. Remember that. So if monthly maximum is 5,000, it means yearly maximum is 6,000. Another is employees above 65 years do not contribute to NSSA. Employees above 65 years do not they don't contribute to NSSA. Are you not seeing something, guys? Maybe for fun, let me talk to you. Are you not seeing that I like typing? Can you imagine, Juliet? I was typing from the first minute until now, non-stop. You know, I could have been like dictating, and you know why? I like typing. You should feel motivated. This should motivate you to know that, oh well, if Say likes typing like this, why is it in the exam I am failing to finish the exam because I'm not able to type? Whose student are you? You have to ask yourself that question. You know? So in a situation like this, I said, remember, employees above 65 do not contribute to NSSA. So if you want now to see, you simply say equals, it's a matter of taking the employees as they are, and we eliminate those who are not eligible. Right? So there you go. There are some who are not eligible for NSSA. So we no longer need the age, but we can now say salary. But remember, employee number. Let me now, if a salary is greater than 60, we pick 60. If otherwise, we choose that number. If a salary is greater than 60, we pick 60. If otherwise, you pick that number. So for employee 1, we take 60,000. Employee 2, we take 60,000. For employee 3, we ignore because these are elderly employees. So we take employee 3 and 4 out because they are not eligible for NSSA. For employee 5, we take 42,000. For employee 6, we take 60,000. For employee 7, we take 60,000. Now, NSSA contribution is 4.5%. NSSA at 4.5%. 5%. So what then do? You say equals this, multiply by 0.04. I know you had come across these questions when you were practicing and you were wondering, when shall we do this in class? Are you not seeing? As I said, you don't get into the exam with anything uncovered. Notice for salaries below 60, we took the actual figure. For salaries which are below 60, like for employee 5, we took 42 because it is not, remember 5,000 is maximum salary. So this is NSSA. So this is like employee contribution. So employee contribution, you add, because this will be from employee salary pay slips, employee contribution, and then you say employer's contribution. Remember we said employee and employers contribute same amount to NSSA, so it will be the same amount. So this will now become total annual contribution. Total annual contribution. If the examiner says employee, you just take employee. If the examiner says total, know for sure that employers and employees contribute same amount to NSSA. So what then do you do? Remember the question said for the month of May. So you say for May, you simply divide this by 12. It's a matter of dividing annual contribution, this one, divide by 12. So for the month of May, the amount of NSSA that was paid was 2,115. This is for the month of May. Now, let us say you had a situation where you had omitted paying NSSA by, suppose you had omitted paying NSSA by, remember I said employers must register for NSSA within 30 days, and NSSA contributions for each month must be paid by the 10th of the following month. So suppose you have not registered for NSSA and I mean you had delayed paying this for 2 months. So now suppose you had delayed paying this for 2 months. So NSSA would then say surcharge. It would say 2 months times 10%. It's per month actually times 2115. You get it? That's it's per month. It's 10% per month, not per annum. So it will be equals to this multiplied by 2 multiplied by 0.1. That. So the amount, suppose you had delayed to pay by 2 months. So the amount that you then have to pay to NSSA, it will be 2115 plus surcharge. 2115 plus surcharge. Expect variations in questions like this. It will be either you'll be asked like to explain or you'll be asked to compute. So always know this. And you know, as I said, tax planning, tax administration looks at various things. And as you have noticed, we have discussed quite a lot. It was like we were doing a recap of what we already know. Now, I was emphasizing in the course of our discussion that some of these tables will be given in the exam. So allow me again to show you where you get these from tables. Where actually do you get these? All right, I'm opening the CBE practice platform for me to show you where you get this, because I know whilst you are practicing, very few questions are available on CBE. Are you not seeing this? These are our taxation past papers. The last paper was the paper written in December. It's not yet loaded on the portal. You get that? This is I'm just opening. This is not CBE, but I just, out of interest, I want to check what is in that paper. So these are the papers you have to practice. Remember, I gave you other papers, but also these are latest papers you have to practice. So you can see now that there are quite a lot of they are like screenshots of the CBE. So for you to read clearly, you have to zoom. Suppose you are zooming this, it will be saying Rudairo is a category A VAT registered operator. Rudairo is working on a VAT return for the month of April, May. So it's like April and May 2019 period. Remember, if you are category A, it means and you are working for the month of April and May 2019 period, you need then, it's a bi-monthly submission. By which dates should Rudairo submit VAT return and remit VAT any respective, if any, for the April-May period? So the tax period is April and May, meaning these are the 2 months that Rudairo is having. So you are already given the period So when in a question like this, don't say, because the examiner has said April and May, by the way, say category A, and then you start to count from January. Yet the examiner is saying the 2 months in category A is April and May. This is the period. The tax period is April and May. So clearly it should be submitted by the 25th of June. And you know, remittance date and VAT return date is the same date. So option 2 will be the answer there. So what I want you to do is, please make sure you appreciate also various multiple choice questions that we have here. Quite a lot of multiple choice questions that we have here. Quite a lot. What amount of input VAT claim in respect of supplies and fixed assets procurement for VAT? Now you understand, under a question like this, it will be saying Jerry is a VAT registered operator and specialized in farming. During the month of June, he procured the following supplies and fixed assets. All the amounts are stated as VAT. We remember we said all the farm inputs are zero rated. Farm inputs are zero rated. So if you are having fertilizer, it's a zero rated. Wheat seed is a zero rated, but delivery van is VATable. So you are told that these amounts are inclusive of VAT. So if you want to find VAT in a delivery van, all you simply do is you say 14,5 over 114,5 times 20. In a water tank, you do the same, and then you get VAT. Are you noticing they like VAT? The second question is VAT as well. They like VAT. Capital gains tax through. So I want you to practice all these questions. And if you don't have downloading options, I will help you downloading these. And right away you practice this. The font is too small. And now this is section B of the paper. You know, the examiners, they tried by all means to take screenshots. So these are just screenshots of the questions, which they were copying and pasting here, copying and pasting here. You get that? So I will download this for you before I exit this lecture today and send them to you, so that when we revise, say next, but I want you to start revising right away. I will download questions and answers as well, because now we have done almost everything. This is not what I wanted. What I wanted was this, your CBE, because your exam is on the CBE platform, and we only have one. We only have December 2019 paper, which is telling us about the CBE issue. So this is our CBE practice. You can open this to have an appreciation of how your taxation paper looks like. So let me again take you through. Whenever you are practicing on paper, you need to know how your question paper looks like in the exam, which is CBE practice platform. So yes, are you not seeing where I'm also getting the paper? I came to past papers here, and there was December thing here. Oh well, not this one. I typed the Tax Zimbabwe past papers, and they were listed here. And then it's saying to practice Tax Zimbabwe exams in the CBE environment, you can access December 2019 sample questions and answers. So what I want is, for your practice, this is the only paper you can have, we can use for practice. This is the only paper we can use for CBE practice. So it is like this. Next. You know, in the exam, you'll be scrolling next. For you to scroll next, you need to click next. You need to scroll everything to the end and click next, so that it allows you to. Suppose I just click next. Notice it doesn't allow me to proceed because I haven't scrolled everything to the end. All these are instructions you need to read. You don't read these instructions in the exam, otherwise you will not finish the paper. So as you are practicing, familiarize yourself with the instructions. Actually, the instructions are actually what I'm talking about. When I'm saying do this, these are the instructions. You can even know them without even reading. Next. So you can see the instructions take me through to the brink of the question paper. Do you really want to start? I click next and then I say yes. That's one thing. Another thing that I want is if you want to jump from one question to another, you click on the navigator button. This button here, which is on the bottom right. If you click navigate, it will populate all the questions. So these are all the questions here listed. Having populated the questions, you can start with any. If you want to start with section B, you can come to section B. And if you want to start with number 16, you click on number 16. Not to click anywhere like here, no. Put your cursor on question 16 and click like this. So if you do this, you'd notice you are already on section B. Notice what this section is on again. It's on VAT. Again, an important point for a question like this one is this point where they say you should indicate with a 0 any amount on which VAT is not chargeable or claimable. If you ignore this part when they are saying indicate with a 0, you run the risk of losing marks. You lose marks. The reason why you lose marks is if you leave it out. Suppose something doesn't have any VAT implications and you leave it out. You would notice what will happen. We will not be in a position to tell whether you left it out because you knew or you didn't even have a clue about it. But if you put a 0, you are telling the examiner that I know that, like, it's like, yeah, allowance for receivables the month of September was 13,000. We don't claim input tax on provision for bad debts, so you put 0. So you say allowance, you come here and pick not point number 2 here. You are calculating VAT payable. Remember, you start by saying output tax, input tax. Now, when you are in the input tax section, allowance for receivables, you put 0. Putting a 0 ends you marks, unlike a situation where you just leave it like that. Goods returned by a customer. I told you that if we sell goods, it's output tax. If customers return goods, it's input tax. So under input tax, you put the figure there. But you shall notice that your answer here will be different from the examiner's answer. Reason, there is a different VAT rate. All the papers at your disposal, when you are answering them for VAT, you shall notice that you are not going to get the same answer. Reason, the VAT rate in these papers was 15%. The new VAT rate is now 14.5%. So in these papers, when they were saying 15 over 115, you are simply saying 14.5 over 114.5. It's simple as that. Remember, I told you that passenger motor vehicle, we don't claim VAT on the cost. If you purchase a passenger motor vehicle, we don't claim VAT on the cost of passenger motor vehicle. So you put 0. But I said fringe benefits, the fringe benefits are VATable, meaning fringe benefits are inclusive of output tax. So you go to the tables. Remember, we are told that these vehicles were given to 2 senior managers. In other words, in your output tax category, you then have to calculate VAT on fringe benefits. But if you come to the tables here, because this question they are saying for the month of September period, just for the month of September. So if you come to the tables, know where you get tables, bottom right, bottom left, where they are saying help or tax tables. So you click there. Notice after you have clicked there, you may say, I clicked and I couldn't find the tables. Surely, After clicking, there are some tabs at the top here. The one is saying help, the other is saying text tables, the other is saying exam instructions. Now, exam instructions, these are, there's no need of reading this. Otherwise, everything we am telling you now are the exam instructions. Now, here's the deal. You click on text tables. You can zoom it to size, zoom it to your desired end. Now, when I say, like on that one, on that part here, when I said you need to find VAT on fringe benefits, you come to your tables and you come to motor vehicle benefits in this table. You know, there will be you come to motor vehicle benefits. We are told that the vehicles had engine capacities of 3000 cc and 2500 cc. So the other one is in this category. The other one with 3300 is in this category. The other one with 2500 is in this category. So you calculate VAT on these amounts, but remember in your table, the amounts have changed. I told you. It's a matter of just opening tables and take the amounts which are there. So you say 14, because this amount is inclusive of VAT. You say 14,5 over 114,5 times this amount. But remember, this is per annum. So you need for September, you then say times 1 over 12. Because you just need for 1 month. Remember then to say times 1 over 12, times 1 over 12. And then on the purchase cost, because I said you don't claim input tax when you purchase a passenger motor vehicle. On the purchase cost, you put 0. So that's how you'll be doing. Are you not seeing where your tables are? Let me again open the tables, because I feel like if I don't tell you that most of the stuff we are doing is given in the tables, you run the risk of cramming. And by cramming, you lose on what matter, busy thinking of figures, yet figures are already given. You know, it's danger. It's danger. There's danger of cramming figures. Yet if you were given these figures, they don't carry marks, yet they took much of your energy and memory space. So here's the deal. So these are the tables. Can you see even capital allowances rates are given? Commercial buildings is given. Everything is given. So you need not even to claim what is the rate for SEA. All you need to know is if the examiner said the taxpayer was claiming maximum capital allowance as possible, you come to the table and everything is there. Don't bother yourself. Now, tax rates, remember this was 25%, now it's 24% for 2020. And then capital gains tax, it was 1 February 2009. I said ignore this part. You need to play the video on capital gains tax. You play that video. I said a lot. Then inflation allowance. So notice the examiner gives you everything, guys. Don't bother yourself cramming. Even on exemptions for elderly taxpayers, notice gains from disposal of principal private residence is exempt. Imagine. Even the sale of vehicle benefit, remember when we said if you are above 55 and you buy a vehicle from your employer at a price which is below market value, that benefit is exempt. It's written here in the tables. You need not to claim all this. You familiarize yourself with all this. And then what else? Okay, you know, the purpose of this was not to say use this table. No. In every paper for now, except when you are answering VAT questions, suppose you are answering this question for VAT, you do notice that the actual answer will be different, but the approach taken must be the same. The approach taken must be the same. For example, this business was making 23,000 per month. Output tax was 23,000 per month and stuff. Clearly, it was in category C. Now in the US, it will be over 88,000. So it's in category C. No wonder why the question number 1 says, in which category do we place this business? it will be in category C, the compulsory registrant. All right, now, still on this, so when you are answering this question, can you imagine bank charges were 1,200 were debited from bank? Remember, we said financial services are exempt. So when they say bank charges were 1,200, it's a matter of putting 0 on input tax. You say bank charges and put 0. Now, what I wanted to say is, you can't say, because the rate used in this question was 15%, so I am not going to answer it. No, you are still going to answer it. But wherever they put 15%, you will be putting 14,5. Wherever they put, so if the amount is inclusive, you will say 15 over 115. That's how they did it. But you will be saying 14,5 over 114,5. If the amount is exclusive of that, if the amount is exclusive, you just say 14,5% of that amount. So here you'll be told that all these amounts are stated inclusive of VAT where appropriate, meaning where applicable. It's not like every figure VAT is applicable. Like you can't say there's VAT on allowance for bad debt. No. So the meaning where applicable. So if you want to find the VAT portion, you'll be saying 14,5 over 114,5. So here is then how you will mark it. When you are now marking this question, like a question like this, when you are marking it for yourself, all you need to do is, you can still mark it correct, provided where you put 14,5%, they put 15%. Where they said 15 over 115, you said 14,5 over 114,5. Provided you are in agreement on the approach taken, you can still mark it for yourself. Is it making sense? Because if I don't tell you the difference in rates, it might not come out right in the exam. You still be in a position of just putting the rates they gave you. Another thing from tables, sorry, last before I download papers. Take for example NASA. Notice NASA contribution, they are saying 3.5% up to a monthly gross salary of 700. You now know that this rate is now 4.5% and monthly gross salary is now 5,000 maximum. We have just done a NASA question before now. All these figures have changed. All these figures have changed. So I told you, we have them in the notes. But don't claim the figures. Can you imagine? Suppose you had claimed NASA, yet it's given here. So what benefit does it give you to claim something we give you in the exam? So don't open the notes and be busy claim the figures. Claim the approach taken, knowing perfectly well that the thresholds of figures will be given in the exam. So you don't serve. But there are certain figures we don't give in the exam, like deemed cost on passenger motor vehicles, deemed cost on staff housing. Those ones, only to the extent of that, you can now have those. But even the VAT rate, notice, in your exam, the tables will be saying standard rate here is 14.5. You'll be given the rate to use in that exam. So you need not to worry much. So there are two approaches. You can even practice this paper using 15%, checking whether your answer is correct. When it is now your exam, you then use 14.5%. 40. Remember, when you are punching 14.5% in the calculator, it's 0.145. That's what you'll be using. So you can practice even using 15% because you know that the rate will be given. So there's no need for you to claim the rate or even to have the hassles of saying, like, our rate is 14.5. Let me use. You can still practice this paper using 14% without any hassle, with using 15%, knowing perfectly well that in your exam, your rate will be given. So even NASA, you can still use, suppose you are answering questions on NASA in this paper, you can still use this NASA rate here, 3.5% a maximum salary of 700, you can still use it, but knowing perfectly well that if my exam comes, instead of 3,5, they will give me 4,5. Instead of 700, they give me 5,000. So I will still follow the same procedure. Can you type noted say on that one? I need an instant feedback on that to just to let me know that what I'm saying here is making sense to you. Just type noted on the chat feature there. Okay, so I can still come to question 1. Okay, so this is question 1. All right. Are you not seeing that the company acquired these businesses, assets? There's industrial land, there's commercial vehicles, there's passenger vehicles. All figures are stated exclusive of VAT. I told you just now that we don't compute VAT on passenger motor vehicles. They like this analog. So it's a matter now of practicing. Let me come to the question list so that we can download the questions. We want to download quite a lot. So let me download questions and answers. I'm sure everything else I have downloaded. I have sent everything else. So all I wanted to download was perhaps September 2020. Because everything else, I'm sure I've downloaded everything. Don't I have September? Actually here, I downloaded this. So there was no need for me to do it. There was actually no need. Okay. All right. So all this doesn't make any. I don't think it of any use to me. Let me delete this. All right. Okay. So what then am I supposed to do? Let me see. All right. All right. So allow me to send, if I haven't sent it already, September, December 20, it's tax, September, December 2020. I want to end my lecture today at 8 because I want to give you something to do tonight. I want to give you something to do, guys. It's quite interesting now. Right. Oh, so what I want you to do is this paper. Can you, as individuals, do this paper, mark it for yourself? If I would appreciate if you finish it. If you finish it, you can. You know what you can do? You can have your lunch. I mean your dinner now. You can have your dinner, and in the next hour, around 8:45. Can you start doing it, say, from 8:45? Can you? Above paper. Above paper. From say 8:45, which is 20:45. 20:45 to 9:45, 10:45, 11:45, 12:45 to 20. Mark it for yourself. Mark it for yourself. Follow the instructions given in the lecture. Follow the instructions. You get that? On the use of tables. On you so much. We do this. I know you're obedient, and I know. Notice. Remember, you asked when you joined. Say, will you be in a position to finish the syllabus? I said we finished the syllabus in 2.5 months. Remember, those were your says words. And by 2.5 months, what did I mean? We had March and April, and then mid-May we are done. Actually, it's not even 2.5, because we actually started around the 14th of March, so it's actually 2 months sharp. So you can tell that, as you say, I have tried by all means to do my level best. So starting next week, we'll just do, say, 2-3 papers with you. Next week it will be an element of getting here, opening a question paper, discuss it to the end of the lecture. The following week we do that. The beauty about doing it on text is because text questions are repeated, paper in, paper out. Every topic is examined. That's the beauty. It's different from all other papers where you have to guess. Are they going to bring throughput accounting? Are they going to bring variance analysis? So you do everything in other papers, but you might not get a question on the topic. Unlike tax, you do VAT, you know VAT is there. You do capital gains tax, you know capital gains tax is there. You do employment income is there. These are not guesses. They are scientific study. So if you can only study a question every day, you are actually preparing for your exam. I have given you guidelines to use when there are changes in figures. You just use your own tables in the exam for the figure in question. But for practice, just use the figure in the question paper. You're welcome, guys. Cheers. Bye. Oh, who was? Oh, no, Feli, you managed to connect, right? That's great. That's great. So do it, guys. Have your dinner and proceed as instructed. Bye.